Welcome back to Daily Crypto. It was a long break. Imagine waking up, checking your portfolio, and seeing nothing but a sea of red. It's terrifying, right? But underneath that surface level panic, the biggest legacy banks in the world are quietly swallowing up a staggering $6 trillion in crypto liquidity. Today, we're diving into this explainer to unpack the unprecedented structural shift happening right now. We're moving past the daily price noise to cover a massive story combining global trade wars, institutional maneuvering, and billions of dollars in shifting capital.
To kick things off, almost $1 billion, $875 million to be exact, was literally just wiped off the map in a sudden market crash. And the crazy part? This wasn't a blockchain exploit or some random hack. It was entirely triggered by the new European tariffs instituted by the Trump administration. It just goes to show how hypersensitive digital assets have become to the chess moves of global geopolitics. We are watching real-time macroeconomic stress play out directly on-chain. So, with retail investors totally spooked and running for the hills, we have to ask the trillion-dollar question: where is the real money flowing? While the front page is screaming panic, the back-end data points to a massive, highly calculated accumulation phase by mega institutions. To truly understand how they're positioning themselves, we need a clear framework.
Here's our roadmap for this explainer today. 1. The global macro shock. 2. The $6 trillion stablecoin shift. 3. Global regulation and crackdowns. And 4. The market outlook and next steps.
Let's jump straight into Section 1, the global macro shock, tariffs, oil, and market outflows.
Okay, so what exactly is causing this massive cratering? Well, those new European tariffs completely collided with a totally unexpected oil shock, creating a devastating cascading effect across all risk assets. Think of it like a domino effect. When traditional markets get squeezed by higher energy costs and trade uncertainty, institutional investors immediately dump their riskiest assets first just to cover margins and protect their capital. That perfect storm is exactly what drove Bitcoin back down to retest that critical $58,000 level, dragging a massive $3 billion outflow right along with it. When the traditional financial system catches a cold, crypto feels the symptoms immediately. But guys, here is where it gets totally fascinating. Look at the split personality of this market right now. On one hand, broader liquidity is absolutely drying up due to those macro outflows. Yet, hyper-niche speculative sectors are just chugging along. Case in point, the Maxi Doge presale is holding completely steady, nearing the $5 million mark. It's a perfect example of how wildly fragmented crypto is. While macro caps like Bitcoin move in lockstep with global equities, microcaps and isolated presales operate in their own totally isolated hype bubbles. Even in a harsh downturn, pockets of high-risk liquidity are still fiercely active.
Moving on to Section 2, the $6 trillion stablecoin shift, traditional finance pivots to crypto architecture.
Now this is absolutely crucial. The CEO of Bank of America just dropped a massive structural warning that we cannot ignore. He's saying we could see up to $6 trillion in traditional bank deposits flood directly into stablecoins. $6 trillion. To put that into perspective, that's basically the entire GDP of Japan packing its bags and migrating from legacy banking into digital architecture. This isn't just a passing trend. It's a systemic global wealth transfer.
And really quickly, for those of you who might be newer to this specific area, a stablecoin is just a cryptocurrency designed to hold a steady value, usually pegged one-to-one with the US dollar or a hard asset like gold. It acts as a bridge. It gives you all the borderless, lightning-fast tech of blockchain, but without the wild roller coaster price swings of Bitcoin or Ethereum. And trust me, the legacy banks finally realized this is the future operating system of money.
Because they're absolutely terrified of that $6 trillion outflow, legacy banking giants are aggressively building their own stablecoin pipelines so they don't get left behind. Barclays just threw down its first stablecoin investment with a stake in Ubix. Over in Japan, SBI Group is launching a trust-backed yen stablecoin, and Tether is pushing the boundaries by rolling out Scudo to tokenize gold. Why are they doing this? Because banks profit from settlement and custody. If the money is moving on-chain, they need to control the toll booths. They aren't fighting crypto anymore, they are quietly co-opting.
Just to put a number on the sheer scale of this institutional land grab, look at Japan's Metaplanet. They literally just closed a $137 million capital raise. This absolutely proves that while retail is panicking over tariffs, heavy institutional money is still pouring cement for the next cycle. They are playing a multi-year game, totally unfazed by temporary macroeconomic headwinds.
Which brings us to Section 3, global regulation and crackdowns, the friction of maturation.
Look, you simply cannot have trillions of dollars migrating to a new system without the global watchdogs losing their minds. We're seeing a highly coordinated tightening all over the world. In the US, senators are slamming the DOJ over conflict of interest rules while a crypto crime unit gets shut down, and New York prosecutors are aggressively targeting unlicensed operations. Across the Atlantic, a UK committee is trying to outright ban crypto political donations. India is flagging vast crypto hawala networks tied to terror funding. Even in China, the literal architect of their digital yuan got hit with an $8 million bribery scandal. It's messy, it's chaotic, but it's the inevitable friction of a maturing market. It's a massive tug-of-war between innovation and control. And the geopolitical stakes are escalating rapidly. Platforms like CoinEx are now being flagged as the largest sanctions exit route for Iran, which puts an enormous target on the entire industry's back. In response to all this mounting pressure, domestic giants like Coinbase are actually threatening to pull their backing for key U.S. Senate bills. Plus, investment banks are warning that the upcoming 2026 U.S. elections might just stall major digital asset legislation entirely. It creates a massive pocket of uncertainty, practically tying the future of decentralized finance straight to the ballot box.
Finally, let's wrap up with Section 4, Market Outlook and Next Steps, Navigating the Volatility. So where do we go from here? Well, analysts are staring down the barrel of a massive $10 billion options expiry hitting tomorrow. It's a total make-or-break moment that's almost guaranteed to trigger extreme volatility as institutional traders scramble to hedge their positions. Given all those macro headwinds we discussed, researchers are warning that a $60,000 to $65,000 Bitcoin range is highly realistic for the near term, and that euphoric $5,000 Ethereum price everyone wanted, experts are saying that looks incredibly unlikely for this current cycle. We are firmly in a period of cold, calculated accumulation right now, not unbridled moonshots. All right, to survive and actually thrive in this complex landscape, here are your 3 actionable takeaways. Number 1, closely monitor macro policy impacts, like tariffs and oil shocks, because they dictate the short-term market liquidity. Number 2, track exactly how legacy banks are adopting stablecoins. That is your $6 trillion long-term play. And number 3, mentally brace yourself for election year regulatory gridlock and adjust your risk tolerance accordingly. Before we finish up, if you found this explainer valuable, please smash that like button, drop a comment with your thoughts, share it with a friend, and hit subscribe so we can keep bringing you these deep dives. I'm going to leave you with this one final provocative question to chew on. As traditional banks swallow up liquidity and aggressively build their own blockchain bridges, will their sheer institutional power actually outpace the global regulators? And more importantly, how are you positioning yourself as this historic financial realignment unfolds? Thanks for tuning into this explainer. Remember, in a market moving this incredibly fast, staying informed is absolutely your